Let me start with something that might make you uncomfortable. If most of your money is sitting safely in a bank account, waiting for the right time to invest, you're not playing it safe. You're guaranteeing a loss. Not a possible loss, a mathematical one. Here's the arithmetic too many smart people ignore. If inflation runs at 3% a year and your savings account pays 0.5%, you're falling behind 2.5% annually. That means every 12 months, the same pile of cash buys less, quietly, invisibly. Stretch that over a decade, and a quarter of your purchasing power evaporates. The number on your bank statement stays the same, but what it can do in the real world shrinks. And that's assuming inflation behaves politely, which it rarely does. I've been told traders and investors like us can't build a real movement on YouTube. So, let's prove them wrong. Smash subscribe right now and comment "I'm in" if you're part of the next 1,000 committed investors. Now, I can almost hear the objection. But cash feels safe. I can see it, touch it, count it. It doesn't drop 20% overnight like stocks. And that's exactly the problem. You're watching the wrong number. You're measuring nominal dollars, the amount printed on paper, instead of real purchasing power, the only number that matters. It's like feeling proud your car's speedometer still works, while ignoring that the tank is almost empty. This is where psychology blinds even intelligent people. We humans suffer from what Charlie Munger calls deprival superreaction tendency, the irrational fear of losing what we already have. We hate the idea of a visible loss so much that we choose a guaranteed invisible one. We cling to cash, terrified of volatility, while inflation quietly pickpockets us year after year. We're so afraid of a 20% drawdown that might recover that we accept a 30% permanent loss over a decade. That isn't safety. That's expensive fear. But here's the question that changes everything. If cash guarantees a loss, why do so many intelligent people still cling to it as their primary store of wealth? The answer isn't found in economics. It's buried deep in human psychology. And in 60 seconds, you'll see why this mistake repeats across generations. Munger's secret wasn't that he outsmarted markets. It was that he outsmarted himself. He learned that the real danger isn't ignorance, it's illusion. He had a simple rule that saved him from countless mistakes. Always invert. Instead of asking, "What should I buy?" he'd ask, "What's guaranteed to lose?" Because if you eliminate stupidity, what remains is intelligence. Invert the cash question, and the answer becomes obvious. Holding large amounts of cash in an inflationary world isn't neutral. It's a guaranteed decline disguised as safety. You're choosing certainty of loss over the probability of gain. That isn't conservative. It's mathematically reckless. Now, Munger didn't learn this from economists. He learned it from physics. In physics, everything moves from order to disorder unless energy is applied. Cash follows the same law. Its purchasing power naturally decays unless you put it to work. That's financial entropy. The second law Munger lived by was compound interest, but he understood its dark side. When inflation compounds faster than your returns, your wealth shrinks in slow motion. It's painless enough that you don't notice, but devastating over decades. Most people think volatility equals risk. It doesn't. Volatility is motion. Risk is permanence. A stock portfolio might drop 15% in a bad year, but cash is guaranteed to drop 3% every year, even in a good one. One pain is temporary, the other is eternal. Warren Buffett and Charlie Munger didn't build Berkshire Hathaway by sitting on piles of cash. They built it by owning productive assets, things that adapt, earn, and grow faster than inflation. When they bought See's Candies in 1972 for $25 million, critics said they overpaid. But See's had something cash never will: pricing power. It could raise prices, protect margins, and grow stronger through inflation. Cash just sits there, shrinking quietly while productive assets fight back. So, what's safer than cash? Munger would say 5 kinds of assets that don't just survive inflation, they thrive in it. Each one grounded in a mental model, a discipline of thought that keeps you rational when everyone else is reacting emotionally. The first, productive businesses. Most people call them stocks, but Munger preferred to think of them as ownership in real companies. A great business with pricing power naturally adjusts to inflation. Think of Coca-Cola. When costs rise, Coke doesn't panic, it raises prices. Its earnings grow, and the value of your ownership grows right along with it. Now, not every stock is a great business. In fact, most aren't. The market is a voting machine in the short term, emotional, noisy, impatient. But over time, it becomes a weighing machine that measures reality. That's why your behavior matters more than the market's mood. If you panic sell at every downturn, even the best business will punish you. If you stay rational, time will reward you. Over the last century, stocks have returned roughly 10% annually. Inflation averaged 3%. That's a 7% real gain versus 0 for cash. You don't need brilliance to see the math. You just need patience and discipline. But even with stocks, Munger warned, stay within your circle of competence. If you don't understand the business, don't own it. Ignorance disguised as confidence is how investors go broke. Know what you know, and more importantly, know what you don't know. That brings us to the second asset safer than cash: productive real estate. Notice the word productive. We're not talking about empty land you hope appreciates. We're talking about property that earns money every month. Rental real estate is powerful because it pays you in 2 ways: income and appreciation. Rents rise with inflation while your mortgage payments stay fixed. Each year, you pay back cheaper dollars and collect higher income. That's compounding working for you, not against you. But again, the circle of competence applies. If you don't understand the work, tenants, maintenance, financing, real estate will punish you just as fast as the market. Now, here's where things start to get even more interesting, because the third asset Munger calls the safest of them all isn't something you can buy on any exchange, and yet it compounds faster than almost anything else.
The third asset, and the one Munger believed was the safest of all, isn't a stock or a property, or even something you can list on a balance sheet. It's you, your own skills, judgment, and earning power. Every person, rich or poor, already owns this asset, but very few treat it like one. Your skills are the engine that powers every other form of wealth. Yet most people spend decades maintaining their possessions and almost no time upgrading the one asset that drives them all: themselves. Benjamin Franklin said it best: an investment in knowledge pays the best interest. And Munger lived that truth. He studied law, mathematics, psychology, economics, not to collect degrees, but to build a latticework of ideas that compounded over time. He called it worldly wisdom. Now think about this. If you've got $50,000 sitting in a bank account and you're early in your career, what's the real opportunity cost? You could keep it in cash, losing purchasing power every year, or invest part of it in training, education, or even a small business that multiplies your earning potential tenfold. That's how compounding really works, not just in your portfolio, but in your brain. Here's the irony. People work 40 hours a week trying to protect their cash, but won't spend 40 minutes learning how money actually works. And that's why most never escape financial mediocrity. The truth is, your earning power is the present value of all your future income. If you can raise that by 20% through new skills or smarter thinking, you've created more wealth than most investments could ever produce. And unlike stocks, your skills don't crash, they compound, and they're inflation-proof. So the next time you hesitate to spend money on learning something valuable, remember this: you're not spending, you're reallocating capital from a dying asset, cash, to a compounding one, yourself. But this raises a dangerous question. If investing in yourself is so powerful, why do so many people stop learning once they leave school? That's the habit Munger said ruins more lives than bad luck ever could. Munger believed the answer lies in what he called psychological laziness, the natural human tendency to stick with what's comfortable. Most people would rather feel certain than be right. They avoid the discomfort of growth and pay for it with stagnation. But the market doesn't care about your comfort zone. It rewards adaptability. It punishes stagnation. And nothing adapts faster than a curious, disciplined mind. That's why Munger viewed education not as a phase, but as a lifelong compounding machine. He once said, "Go to bed every night a little wiser than you were when you woke up, and you'll eventually get what you deserve." Now let's talk about the fourth asset, the one almost everyone misunderstands. High-quality bonds, but only in the right conditions. A bond, Munger said, is just a promise, and every promise is only as good as the one making it. Most investors think of bonds as safe, but a bond yielding 4% in a world of 3% inflation isn't safety. It's a slow bleed. You're tying up your money for decades for a reward that barely keeps you even. That's not risk-free. That's just risk you can't see. The trick, Munger said, is to use bonds strategically, not emotionally. Short-term, high-quality bonds serve one purpose: optionality. They give you dry powder, the flexibility to act decisively when opportunity appears. They're not a wealth engine, they're a waiting room. Warren Buffett often keeps billions in cash equivalents, not to feel safe, but to stay ready. He knows that opportunity loves prepared minds and liquid balance sheets. But notice, Berkshire never hoards cash for long. They hold just enough to survive a storm, then deploy it when the sky's clear. Liquidity is a tool, not a destination. So the rule is simple. If a bond's yield doesn't exceed expected inflation by a healthy margin, it's not protecting you, it's quietly robbing you. And the moment you start calling that safe, you're confusing stillness with stability. But that realization leads to something even more profound. Because there's one last category of assets that flips the whole idea of safety upside down. Munger called them useful hard assets. The things that hold value not because people agree they do, but because they actually do. A farm that grows food, a machine that produces goods, even a vehicle that allows you to earn an income. These are assets tied directly to human productivity, not speculation. Contrast that with gold. Gold just sits there, glittering but idle. It doesn't earn, it doesn't create, it doesn't solve any problem. You buy it, hoping someone else will pay more later. That's not investing. That's speculation with a shiny marketing department. Warren Buffett once joked that if all the world's gold were melted into a cube, you could fit it under a baseball field, and it would just sit there while in the same space, productive assets would be creating billions in real value every year. That's the test Munger applied to every investment. Does it produce? If the answer is no, it's not a wealth creator. It's a psychological comfort blanket. But that logic leads to a hard truth most investors avoid. Cash, like gold, is just another comfort blanket. It makes you feel safe while silently draining your future. And that realization forces the question, if cash isn't the foundation of safety, what is? Because the real secret to wealth, and the real reason Munger outperformed nearly everyone, has less to do with picking assets and everything to do with how he thought. And the next part isn't about what to buy. It's about how to think.
You can hand someone the perfect investment blueprint, and they'll still find a way to sabotage themselves. Not because they lack intelligence, but because they misunderstand their own mind. See, every investor thinks risk is about markets, but risk isn't out there. It's in here, in your reactions, your fears, your biases. That's the invisible tax on wealth that no one talks about, the human brain. Most people think they're being cautious when they hold cash, but that's not caution, that's comfort. And comfort, over time, is poison. Why do you think so many bright people repeat the same financial mistakes decade after decade? It's not ignorance, it's psychology. We're wired for survival, not rationality. Our brains evolved to keep us alive in the wild, not to make compound interest decisions in a modern economy. That's why we chase what feels safe, not what is safe. And it all starts with a few predictable traps of human misjudgment. But here's the real kicker. The traps don't just trick beginners. They trap experts too. Even billionaires fall for them. Let's start with the social proof tendency, the powerful urge to do what everyone else is doing. If everyone keeps their savings in a bank, it must be right, right? Your parents did it, your neighbors do it, your coworkers do it. It feels normal, responsible. But normal isn't always rational. In Weimar Germany, the responsible people holding savings in cash were wiped out by inflation. They did the socially correct thing and lost everything. Social proof doesn't protect you from math, and math doesn't care about feelings. Here's another trap, availability bias. We fear what we can see. A stock market crash is visible, dramatic, and memorable. You see it on the news, in headlines, in panicked conversations. But inflation is silent. It's invisible. It eats away at your wealth like termites in the foundation of a house, quietly, relentlessly. You don't see your money shrinking. You just wake up a decade later wondering why your lifestyle costs more and your savings buy less. That's the irony of fear. People are terrified of volatility, which is temporary, but they ignore inflation, which is permanent. And once you see that clearly, it's impossible to unsee it. Then there's the deprival superreaction tendency, one of Munger's favorite terms. We hate losing what we have more than we enjoy gaining something new. So we cling to our cash like a life raft, terrified of market dips, while inflation steals from us slowly, politely, invisibly. That's why Munger called it expensive fear, because the price of comfort is compounding loss. The solution isn't to ignore fear. You can't. You're human. The solution is to build systems that protect you from yourself. That's why Munger and Buffett have rules, not feelings. They decide their asset allocations rationally, write them down, and stick to them. They don't check prices daily. They don't let CNBC dictate their emotions, because emotion is the enemy of compounding. You don't have to be brilliant to win. You just have to avoid being stupid consistently. And that's what 99% of people never learn. But here's the real paradox.
The biggest threat to your wealth isn't losing money, it's losing discipline. That's what turns a temporary dip into a permanent disaster. Now, let's tie this psychology back to the 5 assets. The reason these assets are safer than cash isn't just math, it's mindset. Each one rewards rationality and punishes emotion. Businesses grow because they adapt. Real estate earns because it produces. Skills compound because they improve. Bonds provide flexibility when you wait. Hard assets endure because they function. Every one of them forces you to act like an owner, not a spectator. Cash makes you passive. Productive assets make you engaged. That's why they're safer. Not because they never fluctuate, but because they reward patience and rational behavior. But here's the dark twist. The more emotional you are, the less these assets will work for you. They'll betray you the moment you panic. That's the real dividing line between success and regret. Not knowledge, but temperament. Munger once said, "The world is full of foolish gamblers, and they will do not as well as the patient investor." So the question isn't just, what should I buy? It's, who should I be while I own it? Now we're getting to the real secret, and it's not what most people expect, because the biggest advantage you can have in investing isn't money. It's time and temperament. But how do you build that temperament in a world that profits from your panic? How do you stay rational when everyone around you is losing their minds? That's where we go next, because understanding how to stay sane when the world goes mad is the last piece of the puzzle. It's the hidden skill that turns good investors into great ones. And it's the one habit that can make every asset you own safer than cash, even in chaos. So let me ask you, when the market crashes and the headlines scream doom, will you act out of fear, or will you think like Munger? Because the difference between those two mindsets is the difference between financial anxiety and financial freedom. The market crashes. Headlines scream panic. Friends are selling. Fear feels like the only rational emotion left. What do you do? Charlie Munger would tell you, invert. Always invert. Don't start by asking what to do. Start by asking what to avoid. Because avoiding stupidity is easier than seeking brilliance. And that single habit, the habit of inversion, has built more wealth than any secret formula ever has. Most investors chase opportunity. Munger chased clarity. He'd sit quietly while others shouted about market trends, and he'd ask one simple question: what are the ways I'm certain to lose? It sounds backward, but it's genius. Because if you remove the guaranteed losers, inflation, impulsiveness, panic, overconfidence, what's left almost has to win. That's how Munger and Buffett turned a failing textile mill into Berkshire Hathaway, one rational decision at a time. But here's the part nobody likes to hear. Even knowing all this, most people will still do the wrong thing. Why? Because emotion is louder than logic, and comfort feels safer than clarity. That's why the crowd always loses, not from lack of knowledge, but from lack of discipline. And that's because if discipline is the key, how do you actually build it? How do you make rationality automatic? Munger had a framework, not for what to buy, but how to think. It's brutally simple, and it applies to every decision you'll ever make with money. 5 questions, 5 filters for clarity. If you answer them honestly, your financial life changes forever. Question 1. What is my circle of competence? If you don't understand it, don't touch it. The fastest way to lose money is to buy something just because it worked for someone else. Most people don't fail from lack of opportunity. They fail from overconfidence. Question 2. What is my real risk? Not volatility, not price drops, real risk. The risk that you won't have enough purchasing power to live the life you want. Cash might look stable on a screen, but in the real world, it's melting. Question 3. What's my time horizon? If you need the money soon, keep it safe. But if you don't need it for a decade, why would you let inflation quietly rob you year after year? Patience is the invisible superpower of compounding. Question 4. What are the second-order consequences? The obvious choice often hides long-term pain. Keeping cash feels responsible until you realize it guarantees poverty over 20 years. And finally, what does inversion tell me? If I keep doing what everyone else does, if I hold mostly cash for the next 20 years, what's the likely outcome? Am I willing to live with that? If the answer is no, then the path forward becomes obvious. But most people never ask these questions. They react, they chase, they panic, and that's why they stay stuck. You see, wealth isn't built by intensity. It's built by consistency. Not by big leaps, but by small, rational steps taken again and again, especially when it's boring. That's the great paradox of money. The moment you stop trying to get rich fast is the moment you start to actually build wealth. And that's what separates the rational investor from the emotional one. Munger said, "It's not supposed to be easy. Anyone who finds it easy is stupid." He meant that real investing isn't about excitement, it's about endurance. It's about choosing a strategy that makes mathematical sense and then having the patience to let it play out, even when the world tells you you're wrong. Now, let's return to those 5 assets one last time and see how they fit into this framework. Businesses grow because they solve problems and raise prices. Real estate earns because it produces and appreciates with inflation. Your skills expand because you compound your earning power. Bonds and cash equivalents give flexibility for opportunity. Hard assets hold value because they serve real human needs. Each one obeys a simple rule. They do something. They produce, adapt, compound, or enable. Cash does none of those things. It just sits there. And what sits still decays. That's why Munger's entire philosophy can be summarized in one paradoxical truth. To play it safe, you must take rational risks, because refusing to risk volatility is guaranteeing decay. And the longer your time horizon, the higher that decay compounds. Now, that's not a message most people want to hear, but it's the truth, and truth compounds too. The final lesson Munger left us with is this. The world rewards rationality in the long run, even when it doesn't in the short run. For decades, he and Warren looked foolish. They didn't chase trends. They didn't buy hype. They were mocked for their patience. But when the smoke cleared, they were the ones still standing. Because compounding doesn't care about opinions. It only cares about behavior. So the real question isn't whether you can find assets safer than cash. You already know what they are. The real question is whether you can become the kind of person who can hold them through chaos. Because the greatest asset of all is your ability to stay rational when everyone else loses their head. That's what makes the 5 assets work. That's what protects wealth. That's what builds freedom. So now, it's your turn. Look at your finances, your savings, your investments, your habits. Ask yourself, am I acting out of logic or comfort? because one will make you rich over time, and the other will quietly keep you poor. And when the next wave of fear hits, and it always will, remember Munger's voice. Invert, always invert. Because the easiest way to win is to stop doing the things that guarantee loss. That's the real secret. That's the rational path. And if you can stay calm enough to follow it, you'll find out for yourself that the safest place for your money was never the bank. It was in you, your decisions, your discipline, and your ability to think when others can't. And that is how rational people build irrational results. The safest place for your money was never the bank.